are always some hints or patterns you can find. You just have to look at it.
So Bernhard, why arbitrage?
In forex trading, we have different ways of making money and also certainly of losing money because you always take a risk. So if you trade like a trend or you trade like a pattern or many other methods, you might win, but you might lose. And even if you trade arbitrage, you might win or you might lose. But if you see something that could help you making an edge in the market, why not using it? And arbitrage is a nice way because if you see something in the market that is very inefficient, you can trade this as arbitrage. It could be between different pairs, it could be between same pair on different brokers, it could be also on one pair on the same broker. So it depends on you.
So what do market insufficiencies mean?
It means that you have a pattern or you have something you found in the pricings of a currency pair and another currency pair that allows you to trade long in the one currency pair on the one side and to go short on the other side. And you make an edge because finally you were equal. You try to, let's say you trade euro US dollar, you are long on the one side, 100,000 units, and you're short on the other side, 100,000 units. Could be same broker, different broker, but finally you're equal. That's the goal. And to achieve this, you want to have the best price on the one side and on the other side. It should be in a way that finally you have a profit. So that's one of the goals, and you find the inefficiency by looking at charts or looking at prices or looking at tick data. And there are always some hints or patterns you can find. You just have to look at it.
And why do brokers offer different prices?
They have different prices because they have different ways of aggregation or going through into the big spot market of currency pairs. So here we can see the price of US dollar, South African rand, and we have 3 different brokers from the left to the middle to the right. And here you can see they all have different prices on the same pair. So if you can see one way to go long in the one and short in the other one, and you make a profit because when you went long, you have a lower price. When you went short, you have a higher price based on this. You have an arbitrage profit, and the pricing is on your side. Here you can see the spread between the different currency pairs. Like in the middle, it's the Dukascopy one. It's 11.07118 to 11.07759. So if you want to go long, normally you have to trigger the ask price. But you can place at Dukascopy, you can place special limit orders called place bid and ask orders. So you can go way close to the bid price, and then you can try to you go long on almost on the bid price inside the spread, and then you can go short on another broker, and then you equal again. And then to solve the positions, you have to close them. You just do it the opposite way. So you're always trading and you go on and you're hedging and you're making money like that.
What is the method of arbitrage trading?
Actually, what I explained before, looking for cheaper prices, getting into the market on one broker, in our case, and then try to hedge or go on the same position size, go in the opposite direction on the other broker. That's the main idea. And the best way to do this is by automatic trading, because a human being is too slow, especially in forex markets. It's very efficient and very fast. So if you see kind of a pattern or possibility of of an opportunity like this, it should be automatic. Otherwise, you're too slow.
Well, thank you for joining us in our studios again, Bernhard.
Thank you, Kais.
That wraps up today's broadcast, but don't forget, you can get the latest from Dukascopy TV by following us on Facebook or clicking on our website. Goodbye for now.